I'm Jason Stipp from Morningstar. Morningstar's August fund flow data showed investors continuing to pull money from fixed income funds and putting money into equity and other categories. But as usual, there's more to the story than that. Here to offer the details is Mike Rawson, a fund analyst with Morningstar. Thanks for being here, Mike.
Pleasure to be here.
So fixed income continued to lose assets. This is a continuation of a trend that we've seen since the spring.
Yes, so May and June we saw interest rates spike, but interest rates have kind of continued to tick up a bit, even through as recently through the end of August, and kind of flirting with that 3% level on the 10-year Treasury bond. So we've seen strong outflows from fixed income, whether it be taxable bond or municipal bond. That's continued all summer.
And of course, before we saw this interest rate spike, fixed income had gotten a lot of assets, so they're nowhere near losing all the assets that they've gained over the last several years.
Sure. People were talking about fixed income being in a bubble, so tremendous inflows in 2012. However, there has been a pretty sharp reversal. In fact, Bill Gross's Total Return Fund, PIMCO Total Return, was one of the largest accumulating funds in 2012. Well, he's lost all of that. About $40 billion in assets have come out since the end of May. A decline in assets of $40 billion. About 26 of that is from outflows. 15 of that is from a negative return on the fund. So it's really phenomenal that last year is one of the biggest accumulating funds, and he's lost it all just within a matter of a few months.
And our data also show that equity, international, and U.S. equity funds gained inflows, and a lot of other categories as well. So we had, except for bonds, for the most part, a lot of inflows into other areas?
Yeah, so taxable bond and municipal bonds, again, strong outflows. This is going on now for several months where we've had outflows from municipal bonds. I think not only are the rise in interest rates, but still that Detroit story hanging over municipal bonds. But the other category groups, such as you mentioned, U.S. equity, international equity, alternatives and commodities, those are seeing inflow. So investors are going to other places. For example, one of the funds in the equity category that was leading in terms of the amount of fund flows was Vanguard Total Stock Market Index Fund. That's one of my favorite funds just because it's so low cost. You get exposure to the entire U.S. market, even down to microcap stocks for a really low expense ratio. So that fund is gaining assets. So the money is going to other places.
And even though fixed income broadly lost money, not every category in fixed income lost money. We did see inflows into a couple of notable categories, one of them being bank loan.
Bank loan, again, continues to be really popular. That category is a small category, only about $120 billion in assets, but it's virtually doubled within a year. And people say, well, why bank loans? Well, it's kind of that perfect solution to the problem of the Fed raising interest rates, or at least beginning to taper. If the Fed does taper, obviously that's going to cause interest rates to go up. Bank loans have a very short duration because they're floating rate, so their interest rates reset, so it's immune to that interest rate risk. Also, there's some credit risk there, but when the Fed raises interest rates, they're probably going to do it because the economy is strengthening. So bank loans should do well in an environment where the economy is doing well.
So definitely know that you're taking on more credit risk, but generally in an environment where rates are rising, we would expect to see fewer defaults overall.
Yes.
Okay, another category in fixed income that did see inflows was the ultra-short bond fund, and I'm assuming this is because, again, that short duration really shields you from rising interest rates.
Yeah, again, I think this is an issue if investors don't know where to go. Fixed income investors, obviously they want the safety of fixed income, but they're not going to get that if interest rates are going up, so they're going into these ultra-short-term bond categories, similar to a money market category, maybe a little bit more yield, but really at these levels, you're just putting your money into a cash-like instrument where you're just waiting for better opportunities. Maybe these are people that are hesitant to go into the equity markets because they view the equity markets as expensive, but they don't want to be in long-term bonds, certainly, so they're going to a very close-to-cash type of investment.
And what about this newer category called non-traditional bond? They're seeing inflows there as well.
Sure, there's one fund. We've talked a lot about PIMCO Unconstrained in that non-traditional bond category, getting a lot of flows. Last month, we saw J.P. Morgan Strategic Opportunities, which is a non-traditional fund, get a lot of flows. So this is a category where the manager has some leeway in terms of the interest rate exposure or the credit exposure that they might take. Now, we read PIMCO's, Bill Gross's views. We know that he wants to invest outside of his benchmark, but really he's somewhat constrained just by the size of his fund. And it's generally, at the end of the day, it's going to be a core type of bond fund. He doesn't want to stray too much from that mandate. But these other, like PIMCO Unconstrained, have the leeway to go anywhere they want. So they're typically taking much less duration, maybe a little bit more credit risk.
Have we seen these funds? Are we comfortable that they actually can do what they're saying that they're able to do?
No, the jury's still out. So this is a relatively new category. Fixed income investors, typically you wouldn't take your risk in fixed income. You take your risk in equities or in alternative strategies. So this is a new type of strategy. They haven't really been tested yet. We went through a cycle in 2011 where they were very popular because people thought rates were going to continue to rise. Of course, after the European financial crisis, rates have continued to actually stay low. So it's yet to be determined whether this is a good strategy for your fixed income investment.
Mike, another thing that we'll often get questions from readers are why do we report fund flows for ETFs and for mutual funds separately, especially given that a lot of the funds are identical as far as what their underlying investments are. But we saw some interesting trends when we looked at where ETF investors in a certain kind of fund and where mutual fund investors in a certain kind of fund, how they were behaving in the recent past.
Absolutely. So we actually get some criticism of why do you report mutual fund and ETF flows separately? Well, Morningstar, if anyone, is very open to the ETF structure. We embrace it. We have a separate ETF team, essentially, who looks at ETFs. But the reason why we separate it out is because ETF investors can be a little bit different than mutual fund investors. Mutual fund investors tend to be long-term investors, and they tend to be average investors like you and I, or mom and pop, just putting their money away into a fund, not necessarily institutions. ETFs are heavily used by institutions, whether that be pension funds, even other mutual funds and other ETFs invest in ETFs. So sometimes the flows there are more tactical. They tend to reverse sharply, and they're not really reflective of long-term sentiment. So what we're observing here is a lot of outflows from ETFs in the emerging market category. Of course, emerging markets have been very weak this summer. They continue to be weak, but institutions are fleeing the area, but we're seeing mutual fund investors continue to invest. I think that's a good story. It's a compelling story. You don't want to sell when the market's underperforming. You don't want to chase returns either. You want to be very disciplined with your investment. So we're seeing that out of mutual fund investors continuing to put money to diversified emerging markets while ETF investors flee that area.
Maybe those individual investors might do better than the smart money, perhaps in this case, over the longer term. Lastly, Mike, you mentioned a couple of the funds that we're seeing inflows and funds that also were suffering outflows. But we have seen some funds, highly rated funds, getting inflows. So the money that investors are putting to work, there seem to be at least finding some of the better funds.
Yeah, there's a number of gold-rated funds. Of course, Morningstar went to the analyst rating system where we have the Morningstar Star rating, which is past performance-based. We also have the analyst rating, which is a future-based predictive measure of funds that we are very confident in. One of the funds which is doing very well is this Oakmark International. Of course, that's run by David Hero. Morningstar members are very familiar with David Hero. He was the International Stock Fund Manager of the Decade, so he's got a good track record. Well, he's certainly putting in another good year. He's up 37% this year. Just phenomenal numbers. In this fund, again, it's gold-rated and it's getting very strong flow. So it's something we would probably appreciate you seeing.
Mike, great insights as always on the Morningstar fund flow data. Thanks for joining me today.
Thanks for having me.
From Morningstar, I'm Jason Stipp. Thanks for watching.